So good evening, class. We will now continue our discussion on asset acquisition, but this time the consideration involved in the problem would be shares. The acquisition is completed by the issuance of shares by the acquirer to acquire the net assets of the acquiree. But before proceeding, I just want us to go over quickly the things that you were supposed to absorb and learn from the previous video involving the asset acquisition, wherein the consideration was paid in cash. So the most basic, again, the most common question asked in these problems would be to compute for the resulting goodwill or gain on acquisition. And as I've told you before, you only need two things if the problem is an asset acquisition to solve for goodwill or gain. And these two things are your consideration and fair value. The consideration paid to acquire the net assets of the acquiree and the fair value of the net identifiable assets. Okay? And aside from being asked for goodwill or gain on acquisition, the other questions that could be asked for asset acquisition problems would be for the amounts that would be reported in the financial statements of the surviving entity immediately after the combination. In other words, you could also be asked for the combined amounts that will be reported in the financial statements of the reporting or the surviving entity. And as I've told you, the process in getting the combined amounts that are to be reported in the financial statements would simply be to combine the amount reported by the acquirer and the amount recognized by the acquiree. But remember that when you transfer the assets and liabilities of the acquiree to the books of the acquirer, you will record those assets and liabilities at their fair value. And that is why when you combine the assets of the acquirer and the acquiree, you add the book values of the acquirer with the fair value of the assets and liabilities of the acquiree. Why? Because again, the assets and liabilities of the acquiree are to be recorded at fair value. The only valuation relevant for the acquiree is the fair value. Okay, but even knowing that, class, it's still possible for you to get the answers wrong if you are careless in some items. The most common area in which students would get wrong would be when the question asks for the combined cash. Ordinarily, if you're asked for combined assets, just add assets of the acquirer at book value and assets of the acquiree at fair value. But why would students get the combined cash wrong? The amount of cash to be reported by the surviving entity immediately after the combination? Because most students would forget that the amounts given in the problem are the amounts immediately before the acquisition or the combination. And there are changes to your cash account during the combination to affect the combination to complete the acquisition. So, as I've told you before, aside from adding the cash of the acquirer and the cash of the acquiree, please do not forget to check the consideration. If the consideration is paid in cash, then definitely that would affect the amount of cash that would be reported by the surviving entity. So in the problem flashed right now, in the discussion earlier, the cash of the acquirer, company A, was 1 million. The cash of the company B, the acquiree, is 150,000. But when you add 1 million and 150, that's not yet the answer because you have to deduct the consideration paid by the acquirer to acquire company B. And the consideration in the problem was 900,000. Okay? But aside from that one, there are two things, again, that you have to remember in computing for the combined cash. Aside from always checking whether or not the consideration is in cash, check whether there are acquisition-related costs. Check whether there are acquisition-related costs. Okay? Because if they are paid by the surviving entity, if they are paid by the acquirer, then they would also affect the resulting balance of your cash. And in the problem, 80,000 was paid for various acquisition-related expenses. Okay, and these are to be deducted from cash because these were already paid. That's why the computation for your combined cash was 1 million plus 150 minus 900 minus 80. Okay. Second item you have to be careful of, class, when asked for combined amounts is if the problem immediately asks you for combined total assets. Supposedly, if you're asked to solve for combined total assets, you just add the the individual assets that are to be reported by the surviving entity, meaning the assets that will already include the assets acquired from the acquiree at fair value. But again, even though the amounts are already provided, even though it's very easy to simply add the aggregate amounts of the assets of the acquirer and the acquiree, and even if you are able to correctly remember that the assets of the acquiree are to be included at fair value, why is it still possible for students to get combined total assets wrong? Because some students would merely rely on the enumeration of the assets provided in the problem. They would only rely on the table given in the problem. And it is expected, it is understandable that the table that is given in the problem will not have any line item for the resulting goodwill. Because again, the goodwill only arises from the business combination. So immediately before the combination, it's understandable that the books of the acquirer and the acquiree will not show the resulting goodwill. So even if you are already able to correctly compute for the combined individual assets of the acquirer and the acquiree, it's possible for you to get combined total assets wrong if you forget to include the resulting goodwill. Do not forget that goodwill is an asset and it should be recognized by the surviving entity. So the reminder now is that you should add the resulting goodwill. But of course, if the transaction did not result in a goodwill, if the transaction resulted in a gain on acquisition, then definitely, even if you forget the important reminder for combined total assets, you would still get the correct answer. Okay, because most students would get combined total assets wrong. Aside from forgetting what will affect the cash balance, they would forget to include the resulting goodwill. Okay, you'll catch a lucky break if the problem does not result in goodwill. So even if you forget about the reminder about goodwill, you'd still get it wrong if the problem does not result in a goodwill. Okay, but again, most problems result in goodwill, class. So I strongly I strongly urge you to remember to never forget to include the resulting goodwill. And it's very common, class. Given how the problems are presented, it's very common for students to forget your resulting goodwill. Even though the first question asks for the goodwill, class, it's very common that students would still forget to include the resulting goodwill. They would forget to incorporate it in the assets of the surviving entity. And I hope that does not happen to you, class. I hope my reminders are enough that in computing for combined total assets, you have to monitor whether there's a resulting goodwill or not. Okay. So focusing now on the second scenario, class, the same problem, class, the same parties involved. The acquirer is still company A, the acquirer is still company B. Okay, acquisition related cost is still 80,000. Okay, but this time instead of the acquirer paying 900,000 cash, the scenario in problem B, class, is that Company A, the acquirer, issues 32,000 of its shares to acquire the net assets of Company B. Okay. Before I forget, another thing that you should have learned already is the treatment or the recognition of your acquisition-related cost. For all costs related to the combination, class, it should be reported as an expense. And what would be the consequence? Since it is an expense and expenses are ultimately close to your retained earnings, okay, do not forget that it would have an effect on the retained earnings that will be reported by the surviving entity. And as a rule, as I've mentioned before, for your shareholders' equity, you do not combine it with the shareholders' equity of the acquiree, because that would result in double recognition of the net assets. Because since you already recognize the assets and liabilities, you have effectively recognized the net assets already. So when you're asked for the shareholders' equity to be reported in the financial statements of the surviving entity immediately after the combination, it's not really a combined amount, but it's only the shareholders' equity of the acquirer or the surviving entity. But just do not forget, if you're asked for combined retained earnings or the retained earnings after the combination, please take into account the expenses. Do not just simply adapt the amounts reported or shown in the problem. Why? Because the shareholders' equity accounts presented in the problem are the amounts immediately before the combination. And the problems will ask you for the amounts to be reported in the financial statements immediately after. Since the given information is for immediately before, then that means it has not yet taken into account the resulting expenses or the related expenses to the combination. Okay. Another important theory class would be the treatment for stock issuance cost or even bond issuance cost class. Okay, this is not something new. This is not novel to PFRS 3 class. For stock issuance cost, they would be treated as a reduction to your share premium. Okay, so please do not forget, when recording the issuance of shares, you will have to deduct the stock issuance costs, the costs related to the issuance of the shares. And definitely, this will only arise, class, if the consideration is in terms of shares. Okay? Or if the consideration is not in shares, if the consideration is in terms of bonds, debentures, or debt instruments, then just remember your PFRS 9 class. Under PFRS 9, bond issuance costs are to be included as part of the cost of the or the fair value of your bonds. So you will have to include the bond issuance cost in determining the consideration. Okay, if it's paid by the acquirer, then it would be an deduction to the it would be an addition to the cost on the part of the acquirer. Okay? So again, that's not something new. That's the same as your PFRS 9. Bond issuance cost, you can just look at it this way, class. Common error on the part of the students is when they are asked for the amount to be reported as an expense as a result of the combination, they would include bond issuance cost and stock issuance cost. What are to be expensed? Only those acquisition-related costs that are not that are related to the acquisition but are not related to the issuance of the bonds or the shares that are used as consideration in the combination. Okay, just remember, everything else should be expensed except for bond issuance cost or stock issuance cost. Okay, they are either additions or deductions to your shareholders' equity or your uh, bonds payable. Okay, so focusing now on the second illustration, class, on the second scenario for our first illustration, Company A issues 32,000 shares to acquire the net assets of Company B and pays 70,000 for stock issuance cost. As I have mentioned, the stock issuance cost is again going to be deducted to the resulting share premium from the issuance of the shares. When you record the 32,000 shares issued to acquire Company B, it should already be net of the 70,000. Okay? But remember, Klasa, that the 70,000 stock issuance cost had to be paid. It had to be paid in cash. So what could be a possible effect? Okay? It would affect your computation of the combined cash after the combination. In the problem before, what were the things we considered in computing for your cash? Aside from the cash balances of the acquirer and the acquiree, we take into account the cash consideration and the acquisition related costs. But please don't forget that even your stock issuance cost would also involve disbursements or outflows of cash. So definitely these should be considered when computing for your cash later on. Okay? But let's focus first on the issuance of the shares. Now, if you'll see here, class, it's the problem tells us that the shares of company A have a par value of 10 and a fair value of 25. Now, as I've told you, class, everything in a business combination are to be measured in fair value. And this is what makes business combination unique, class. Okay, Prawela. Okay. If you'll if you'll remember in your PPE class, in your discussion in past 16, property, plant, and equipment, if you acquire an item of property, plant, and equipment for your shares, you do not use the fair value of the shares issued class. The first consideration or the first amount that will be assigned to the asset class will be the fair value of the asset acquired. Okay, and whatever is the fair value of the asset acquired, then the value that you will assign for the shares that are issued to acquire the PPE would just adjust. Okay, and this is now one of the main reasons, class, why it's very likely for a business combination to result in a goodwill or gain. Because when you acquire the asset class, you debit the asset. Then since the consideration is in shares class, you would credit share capital and you would also credit share premium. Now there's the entry would always be balanced class. Okay, the amount that you record for your asset class would be the fair value. Okay, and the total your total credits for the entry for the acquisition of the item of PPE class would just depend on the value assigned to your asset. And as you should know, the amount that should be credited to your share capital is always at par value. And your balancing figure would always be, and your balancing figure would just be your share premium. So whatever is the difference between your fair value and the par value of the shares issued, the balancing figure would be your share premium. Okay, but when we are now dealing with uh, business combination class, assuming no liabilities class, you would still debit the asset and the asset would still be recognized at fair value. Okay? And if shares are issued to acquire the assets of the acquiree, of course, you will credit share capital and you would also credit share premium. Okay? But in a business combination class, it goes without saying that the credit to share capital would be at par value. Okay? But in a business combination, But in a business combination, the share premium will not serve as the balancing figure class. Okay? The share premium will not serve as the balancing figure. The amount that will be recognized as share premium from the issuance of the shares in the business combination would represent the excess of the fair value of the shares over the par value of such shares. So you can easily understand, class. There's no need to recognize another asset when you're acquiring an item of PPE per past 16 because the rule is to record the asset at the fair value of the asset acquired, and the share capital is always at par value and the share premium will just serve as your balancing figure. But in a business combination, the asset acquired is still measured at fair value, but the shares issued class the should also be recognized at fair value. And since it's possible, class, that the excess of the fair value of the shares over its par value may not be the same as the balancing figure of the par value and the fair value of the asset acquired. So it's very possible that your debit here, your total debit here will not be equal to your total credit. So in that case, you will now have to recognize another item. So if it's the debit that is lacking, then you would recognize goodwill. Okay? But if it's the credit that is lacking, then you will have to recognize gain on acquisition. Okay? But no transaction should result in both goodwill and gain on acquisition, class. Goodwill and gain on acquisition are alternatives. Okay? Depending on which one is greater, the fair value or the consideration. If it's the consideration that is greater, then you will have goodwill. If it's the fair value that is greater, then you will have gain. Let me write that down. If consideration is greater than fair value of the net assets, then it will result in goodwill. If it's the other way around, if fair value of net assets is greater than the consideration, then the result would be a gain on acquisition. Okay, so I hope these entries, class, would help you understand why a regular purchase of PPE would not result in a goodwill, but a business combination would result in a goodwill. This is one good reason. Okay, because the total credit to your share capital and share premium would depend on the fair value of the asset acquired, even though it does not represent the fair value of the shares issued. But in a business combination, class, you still record the asset acquired at its fair value, but to record the shares issued in the business combination, the total credit to your shareholders' equity should represent the fair value of the shares issued. And the fair value of your shares issued, class, may not reflect the fair value of the net assets acquired. And because of the possibility that the net assets acquired, the fair value of the net assets acquired is not the same as the fair value of the shares issued, then you will have to have a balancing account. And depending on which side is lacking, it will result in a goodwill or a gain on acquisition. Okay. Now let's go back to the problem, class. Okay. So here, the consideration is 32,000 shares. Okay, and the problem tells you that the fair value of the shares is 25,000. 25 pesos per share. Now, if you are to prepare an entry, class, or if we are to compute for the resulting goodwill or gain, as I've told you, that's the most common question. To compute for the resulting goodwill or gain, class, again, we just need our consideration and our fair value of the net assets. So consideration, as I mentioned earlier, should be measured at fair value. So what was the consideration for problem B or scenario B, class? 32,000 shares are issued. Okay, and how much is the fair value of each share? Each share has a fair value of 25. So your total consideration then is 800,000. And what are you supposed to compare, class? Your consideration to arrive at the resulting goodwill or gain. You compare it with the fair value of the net assets. Okay, I know we've computed for the fair value of the net assets in the previous video, but I forgot to take note of the amount, so we'll have to add it again, class. Okay, so take note, class, even if there's a change in the consideration in the mode of payment, instead of cash, we're issuing shares, the fair value of the net assets class should not change because we're using the same problem. The only difference between scenario A and scenario B is the consideration. Okay, so there should be no difference in the fair value for the net assets because we are using the same problem. So I think we can just work back to this one class to arrive at the fair value of the net assets. Before, in scenario A, the consideration is 900,000 and the resulting goodwill is 70,000. So if there's a goodwill of 70,000, that means the fair value of the net assets must have been 830,000. I hope you're able to follow. Instead of recomputing for the fair value of the net assets, knowing that the fair value of net assets would just be the same, I'm just working back the amount just to prove. Okay, based on scenario A class, we were able to compute before that the resulting the resulting goodwill is 70,000. Okay, and we know that the consideration was 900,000. Okay, so to work this back, just deduct the 70 from your 900,000, and indeed the fair value of net assets is 830,000. These should not be complicated. Okay. Again, I'm just going over this one because it takes too much time to recompute for the fair value of the net assets. If you have time on your own class, you recompute for the fair value of the net assets, and it should give you 830,000. Sorry, I forgot to change the uh, screen that is being shared. Okay. So now, class, the consideration was 800,000, and how did we get 800,000? Okay, understand that the consideration is different this time. How did we get 800,000? It was the 32,000 shares issued by Company A to acquire Company B. And since the fair value of each share is 25, 32,000 times 25 would give you 800,000. And since the fair value of the net assets is 830,000 class, again, as I've told you, all you've got to do when you have both the consideration, the fair value of the net assets, is to deduct the two amounts. Okay, so 800,000 minus 830,000 would give you negative 30,000 plus. Okay, and since it's a negative amount, it represents a gain on acquisition. So it makes sense, class, if you'll get confused, class, why a negative amount will be considered as a gain. Just think of it this way, nga, we assign the positive to your goodwill, class, and the opposite would be your gain on acquisition. Do not overcomplicate this one, class. Okay? It's just that we are starting our formula with the consideration and deduct our fair value of the net assets. Okay, we assign the positive sign to goodwill because uh, most acquisitions will result in a goodwill. Again, please do not overcomplicate why a negative is referred to as a gain. So we already have our answer, class. The combination, if the consideration is in terms of 32,000 shares with fair value of 25 pesos each, the transaction will result in a gain of 30,000. Okay. Other term for gain on acquisition, class, is negative goodwill. Okay, you have a negative goodwill of 30,000. Okay. Now to proceed to the other questions. Okay, just like in the earlier scenario wherein we computed for the individual amounts. Let's start with cash for a while. Okay, so let's compute for a combined cash. Okay, so ordinarily, what do we do to solve for combined cash? We just add the cash balance of the acquirer and the acquiree. For cash class, you don't even have to be worried about fair value class because the fair value of your cash balance would always be its face amount. Okay, and the book value that will be assigned to it would also be its face amount. Okay, but just don't forget that you record or recognize the assets and liabilities of the acquiree at fair value. Although that's again not a big issue for or an issue at all for cash. Okay, but still, to compute for combined cash class, you add the cash balance of the acquirer, who is company A, and the cash balance of the acquiree, who is company B. Company A has cash of 1 million, while company B has cash of 150,000. Normally, adding these two amounts would be enough, but we already know that adding these two is not enough if we're computing for cash because again, there are transactions that affected cash during the combination to complete the combination. Okay. And what were the things that you're supposed to remember, class? Check whether the consideration is in cash because if the consideration was in cash, you have to deduct the cash payment. Okay. But in problem B, was the consideration in cash, class? The answer is no. So no need to deduct any consideration. But does it end there? No, because aside from checking the consideration class, you also have to deduct payments, all payments class. And what items normally require payment in a business combination transaction? Number one is your acquisition related costs. And again, just like in scenario letter A, company A paid 80,000 for various acquisition related expenses. Will this affect your cash? The answer is yes, because this is taken out of the cash balances of the surviving entity. Okay, so 1 million plus 150 minus 80,000 plus. Okay, and in problem A before, class, that would have been enough, but please be careful. Read the entirety of the problem because in problem B, class, aside from the issuance of the 32,000 shares, in relation to such shares, class, company A had to pay for stock issuance cost in the amount of 70,000. And since these amounts were paid for, it would again affect the cash balance. So aside from deducting the 80,000, class, you would also have to deduct the cash payment for stock issuance costs in the amount of 70,000. So the complete computation now for our combined cash, class, the complete combination for our combined cash is 1 million plus 150 minus 80 and minus 70,000. And that would give you 1 million. Again, how did we get our 1 million? We added the 1 million of the acquirer. We added the 150,000 of the acquiree. We deducted the acquisition related cost of 80,000 and we deducted the stock issuance cost of 70,000. And that would give us the 1 million. Okay, so if we are to summarize, class, what are the things you have to remember when computing for the cash balance immediately after the combination? Cash balance of the acquirer plus cash balance of the acquiree minus cash consideration, if any, minus payments. Payments for what? Payments for acquisition related expenses and stock issuance cost. Okay. So please don't forget those items, guys. Cash would be one of the trickier items that will be asked in business combination problems. Now going now to the other items, class, that could be asked. Aside from cash, it would be accounts receivable. Okay, and for accounts receivable, there's nothing tricky here. So you just add 400,000 for company A and 100,000 for company B. Why 100,000 for company B? Because the relevant valuation for the acquiring is the value. So this would be 500,000 for uh, accounts receivable. For a while. Okay. Next item would be your inventory. And you can expect that the amount here would be the same as what we've computed before. This would be 300 plus 70. Okay, so that would give you 370,000. And then next to inventory are your other current assets, which would amount to 760,000 computed as 600 plus 160. Other from your other current assets, you have your PPE and your other non-current assets. For your PPE, it's simply 900,000 plus 250. Why 250? Why not 270? Because again, the relevant valuation is 250 fair value. So this would give you 1,150,000. And then for other non-current assets, simply add 800,000 and 280,000, which would give you 1,080,000. Okay. Now we have the amounts that will be reported by the surviving entity class. And if you will be asked how much is the combined total assets, how much is the combined total assets under scenario or case B class, just add the individual assets. Okay, and that would give you 4,860,000. But what was my reminder or warning to you before? Be careful in solving it this way nga, you should remember including your goodwill. Okay, make sure to be able to include your goodwill. But why is our answer correct? Even though we just added the individual assets, even though we forgot to include goodwill. Because in scenario B class, there was no resulting goodwill. The transaction did not result in goodwill. Okay? So it's possible class, even though you're very forgetful, even though you're very careless, you would still get the correct answer if the item you forgot about was not a factor or an issue in the problem. But again, kasi I cannot emphasize this enough. Make sure to not forget to include any resulting goodwill. Even without including goodwill in this solution class, we are able to arrive at the correct answer because there was no goodwill to include in the first place. Because what was the result of the acquisition in problem B? It resulted in a gain on acquisition in the amount of 30,000. Okay. Now, what are the other questions? We've computed for goodwill 30,000, cash 1 million. Again, Klasa, please don't forget the things you should remember for cash. Okay, the consideration, acquisition related cost, and stock issuance costs. Anything that has to be paid to perfect or complete the transaction class should be taken into account in computing for your combined cash. Okay. Now, this is what makes stock issuance problems interesting, class, which is not present when when the consideration of the problem is in cash. Okay. Earlier, when we were asked to solve for the share capital to be reported by the uh, surviving entity, we said no need to add the share capital of the company B because that would be a redundancy. Just adopt the shareholders' equity of the surviving entity. That's the rule. Unlike your assets and liabilities, you would be adding the balances reported by the acquirer and the acquiree. With regard to your shareholders' equity, class, it should just be the amount reported by the acquirer. Okay, but be careful. While this was not an issue before in problem A, this is a big issue if the consideration is in terms of shares. Okay, because the 600,000 you can see here, class, does not include yet the additional 32,000 shares issued by company A to acquire company B, because again, these balances are immediately before the combination. And as a result of the combination, since the acquirer issued 32,000 shares, class, it should have a change on your shareholders' equity. It should change the balances to be reported by the surviving entity for its equity accounts. Okay. While I will not show you the complete entry for the acquisition, class, you should be able to understand, it should make sense to you that since the consideration is in terms of shares, it would result in the corresponding increase in the equity accounts of the acquirer. Okay. So the challenge on our part now would be to determine how much is the resulting balances of the equity accounts of the acquirer. Okay, so let's try to compute for the share capital. Before the combination, class, share capital was 600,000, but what happened? Uh, Company A issued 32,000 shares. Okay, without focusing on the debit side, class, what do you think would be the credit to recognize the issuance of the shares? It definitely would involve credit to share capital and credit to share premium. Okay. Now, how much do you think would be the credit to share capital? As always, class, the credits to your share capital should only represent the par value of the shares issued. But I thought that the rule is to recognize the shares issued at fair value. That's correct. Okay, but as to the share capital account, the amount that should enter this account should only be the par value. And since we are going to record it at fair value, the excess should be recognized in your share premium. So for the issuance of the shares, class, okay, how many shares were issued, class? 32,000. How much was the par value of the shares? The par value is 10. And that should be the amount that will enter our share capital account. So, there being 32,000 shares issued with a par value of 10, the total credit or the total increase to our share capital should be 320,000. Okay, now share premium is where it gets interesting because there are things you have to be careful of. The amount that should be credited to your share premium, class, should be the excess of the fair value over its par value. How much was the fair value, class? 25. How much is the par value? 10. So for each share, there is an excess or a premium of 15 pesos. Okay? And how many shares were issued? 32,000. Okay? And how much was the excess or premium for every share? Since the fair value is 25 and the par value was 10, each share has an excess of 15. Okay? So the credit to your share premium, class, should be 480,000. But what else are you supposed to remember, class? What else are you supposed to remember? that stock issuance costs are to be charged to your share premium. Okay, how much then is your uh, stock issuance cost? Okay, as stated earlier, class, since it is to be charged to share premium, we will have to debit share premium and credit cash paid for uh, the cash paid for the stock issuance cost. Okay, since the problem stated that stock issuance cost amounted to 70,000, that means this is the amount that would be charged to your share premium or to be deducted to your share premium. Okay, now this is where students get it wrong. They are able to get this entry, credit to share capital 320,000, credit to share premium 480,000, but they would forget to recognize the decrease in share premium because of the stock issuance cost. So the net change then, the net change to your share premium would be 410,000. Okay, so that would be the amount of change or increase in your share premium, which leads us back to the question. How much is the share capital? Let's go back. Share capital, immediately before the combination, share capital was at 600,000. But because of the issuance of the 32,000 shares class, we credited share capital in the amount of 320. Okay? So share capital then, as a result of the combination, would now be 920,000. How did we get 920,000? The 600 immediately before the combination and the increase of 320 as a result of the issuance of the 32,000 shares. So that's why the answer, class, is 920. Next, share premium. Immediately before the combination, class, share premium was at 300,000. Was there any changes to Were there any changes to share premium as a result of the acquisition? Yes, because we issued shares above par value because the shares issued for the combination are to be measured at fair value. How much was the net change to our share premium? The net change was 410,000. So before the combination, we had share premium of 300,000. Since there is a net increase of 410, 480,000 excess over par and 70 stock less 70 stock issuance cost, our share premium immediately after the combination would now be 710. 300 plus 480 minus 70. That would give us 710,000. Okay, I hope you are able to follow. Now, why were these not an issue in problem A, class? Because the consideration in problem A was in cash. Shares or share capital were not involved. Okay, why is this an issue now? Because in problem B, the consideration was not in cash but instead in shares. As a result of the share issuance of shares, there will be changes to your share capital and share premium. Okay. Next, last question, class. Compute for your retained earnings. Compute for your retained earnings. Again, the retained earnings was 2,500,000. Okay. In problem A, class, we deducted 80,000 from 2,500,000, representing the acquisition-related costs because, again, those costs are to be recognized as an expense. Okay? And in problem B, class, the 80,000 would still be recognized as an expense. So that would, the computation for the retained earnings after the combination would still be 2,500,000 minus 80,000. Okay, but as you can see here, class, the answer is not the same in problem A. The answer here is 2,450,000. Why is it not 2,420,000? Even though our formula or our solution is 2,500,000 minus 80,000. Because in problem B, class, the transaction resulted in a gain on acquisition in the amount of 30,000. And it being a gain, it will result in an increase in your retained earnings. So it's 2,500,000 minus 2,500,000 minus the acquisition cost of 80,000, but plus the gain on acquisition in the amount of 30,000. Okay? So that's why the retained earnings in problem B, class, would be 2,450,000. Now, if I am to summarize, class, so we've essentially answered problem A and problem B already. If I am to summarize, class, the things that you have to remember when you're asked to compute for the amounts that are to be reported in the financial statements of the surviving entity immediately after the combination, we'll have to start with the most common question, which is the computation of your goodwill or gain. If it is an asset acquisition, class, the computation of your goodwill or gain is very easy. Just compare your consideration and your fair value of your net assets. Our formula is uh, consideration minus fair value of net assets. Okay, it would give you your goodwill. If the amount is in negative, if you have a negative goodwill, that means you have a gain on acquisition. And again, in most cases, the consideration would already be given. The only way it's not directly given is just like in problem B, class, wherein you have to compute for the consideration by multiplying the number of shares issued with the fair value of the shares. Okay, but that should not be difficult. Second, be careful, class, if the question is combined cash or the cash to be reported immediately after the combination. Ordinarily, if you're asked to compute for the assets and liabilities to be reported after the combination, all you have to do is to add the assets and liabilities of the reported by the acquirer with the assets and liabilities reported by the acquiree, but make sure that the amounts that you will include for assets and liabilities of the acquiree are at their fair value. Adding those two amounts should be enough. But if you're talking about cash, if you're asked to solve for cash, class, there are things you have to remember. There are things that affect cash as a result of the combination. So instead of just adding the cash balances of the acquirer and the acquiree, what else do you have to remember? Please do not forget to deduct the cash consideration if the consideration is in cash. If it's not, then there's no problem. Okay, that's one. Number two, acquisition-related costs. Since acquisition-related costs are normally paid, they would represent a deduction in your resulting cash. That's number two. Number three would be for your stock issuance costs if the consideration is in terms of shares. So normally, even though there are three things for you to remember, class, cash consideration, cash payments for acquisition-related cost, and cash payments for stock issuance cost, these three will not coexist all at the same time. Why? Because cash consideration precludes stock issuance cost. Okay, when does stock issuance cost exist, class? Only when the consideration is in terms of shares. What is the scenario in which these three could be present in the problem, class? What is the scenario in which these three could be present in the problem? It can happen if the consideration is partly in cash and partly in shares. That's possible if the consideration is mixed. Okay, so just remember that there are three things for you to check if the question is for combined cash: cash consideration, payment for acquisition related costs, and payment for stock issuance costs. Is that clear? Sorry. For all other For all other items class, just add book value for the acquirer, fair value for the acquiree. Now, another common question that students would normally get wrong is to compute for the combined total assets. Okay, so again, this is a scenario. You already know how to compute individually the combined assets. Okay, the individual assets, the combined individual assets. But why is it still possible for you to get the combined total assets wrong, class? Because even though your individual components are correct, you would get the total amount wrong because you will fail to include one asset that is not visible from the problem. And what asset is normally forgotten by students, class? It is the resulting goodwill from the business combination. Because the trial balances that will be provided in the problem will not show or will not provide a line item for the goodwill, because the trial balances that are given are for the amounts immediately before the combination, and the goodwill only arises as a result of the combination. Okay, so compute your cash correctly, compute all other assets correctly, and do not forget to include the resulting goodwill, if any, in computing for your combined total assets. Okay? If you're lucky that you forgot goodwill and it so happened that the problem did not result in a goodwill, then good for you. Okay, but for you to get all the problems right, do not forget to include the resulting goodwill. That's why almost always the first question is to solve for the goodwill or gain. For your liabilities class, there's nothing special to remember there, unless of course the consideration is in bonds, but that's very unlikely. It would just result in additional liabilities on the part of the surviving entity. Let's proceed to the shareholders' equity. What's the rule for shareholders' equity? Is it the same as your assets and liabilities? No. In your assets and liabilities, you combine the amounts provided for the acquirer and the acquiree, but the acquiree is at fair value. For shareholders' equity class, it's just the shareholders' equity of the surviving entity, who is normally the acquirer. Okay? Now, the things that you are to be careful of, class, for shareholders' equity is when the consideration is in terms of shares. If the consideration is not in shares, class, your shareholders' equity will just be the same as the shareholders' equity reported by the surviving entity immediately before the combination, with the exemption that you have to be careful with regard your retained earnings. Okay, but as to your share capital and your share premium, it would just be the same amount as the amounts reported immediately before the combination. But again, that is if the consideration is in cash, if the consideration is not in shares. Okay, so if you're asked for the shareholders' equity to be reported immediately after the combination class, make sure to check whether the consideration is in shares or not. If it's in shares, that should raise a flag, and that should make you more vigilant that there are things that you have to be careful of. If the consideration is in cash, then you can relax, class, and simply rely on the balances reported by the surviving entity immediately before the combination. Okay? So if the consideration is in shares, what are the things you have to be careful of? For share capital class, very simple. Just add the increase in share capital resulting from the par value of the shares issued. Okay, again, share capital is always at par value. Share capital is always at par value. While the excess class, since shares issued for a business combination are to be recognized at fair value, the excess of the fair value over the par will go entirely to your share premium. So that would again cause a change in your share premium. Okay, and if that's the case, the share premium that will be reported immediately after the combination will not be the same as the share premium reported by the surviving entity immediately before the combination. So again, possible changes for your share capital, the par value of the shares issued. Possible changes for your share premium, the excess over the par of the shares issued. But aside from that, are there other possible items that will be deducted or that will affect your share premium? Yes, if there are stock issuance costs. What's the effect of your stock issuance costs? it would be a deduction to your share premium. So share premium may increase as a result of the issuance of shares above the par value. Okay? If the fair value of the shares are greater than the par value, then your share premium is expected to increase. Okay, but such increase could be reduced slightly reduced by the stock issuance cost. Okay. Now, in the rare instance that the increase in share premium is not enough to cover the stock issuance cost. Okay, the excess over the par is not enough to cover the stock issuance costs. Is it possible for you to have a negative share premium? No. That would just mean that you will have additional share premium of zero. So what then will happen? The unabsorbed portion, okay, stock issuance cost not absorbed by the additional share premium will be deducted to your retained earnings. That's another item that could affect your retained earnings. Okay, I'm just able to mention that right now. For a while, so let me just charge my laptop. Okay. So what are the things for you to remember for your share premium? It will be increased by the issuance of shares if the fair value is greater than the par value. It would be decreased going down if there are stock issuance costs. Okay. Now, what will happen if uh, the additional share premium from the issuance of the shares is not enough to cover the stock issuance costs? Okay. You bring down the additional share premium to zero, and the unabsorbed portion would be charged to retained earnings. Okay, the unabsorbed portion would be charged to your retained earnings. Now, for your last item, for your retained earnings, what are the things you have to remember for your retained earnings? Ordinarily, it is supposed to be just the retained earnings of the surviving entity. But you cannot just rely on the retained earnings given in the problem, because the retained earnings given in the problem is the balance immediately before the combination. During the combination, or to complete the combination, there are items that would affect your retained earnings. And what are these items? Number one, acquisition related costs. Okay, if there are acquisition related costs, that would be a deduction to your retained earnings. Number two, gain on acquisition. If the combination resulted in a gain,